Welcome back. 2019 has been a good year for investors. We've seen several record highs. Tech stocks have just been on fire this year. And here to talk a little bit more about what actually happened in 2019 and why we saw the market so strong is Massud Ghaussy, the senior analyst with Nasdaq Market Intelligence. So,
thanks for having me, Jane.
Great to have you back.
Yep.
So let's just start with kind of describe 2019. Like, how would you, if you were writing a headline or kind of a summary, what would you say about this year?
So the last year and a half, the primary driver of markets have been trade tensions, namely tensions between U.S. and China. And everything else, the Federal Reserve, central bank, companies' CapEx plans, the economy, both global and domestic, and markets essentially have been a reaction to trade tensions. And going forward, until there is either a permanent standstill or a resolution with trade, the primary driver of the market will continue to be trade tensions.
Yeah. Well, what's been so interesting to me is that despite this, and kind of there's so many mixed signals with trade, and then there's talk about bringing up the tech companies, but the market is just ignoring all of that and just soaring higher this year.
I think we should begin with 2018, the fourth quarter of 2018.
Okay.
We saw the markets enter into bear market territory, so down approximately 20%. And the primary reason for that is, well, obviously there was a trade tension starting to escalate, but we had the Federal Reserve finally taper their 10-year accommodative monetary policy. Yep. So for a good 10 years, not only the Federal Reserve, but central banks have been injecting liquidity into the system. It saps volatility, so there's excess cash in the system, which usually creates inflationary pressure. And as a result, markets have been rallying over the last 10 years. But when the Fed reversed that, within a span of approximately 6 weeks, the market entered into correction territory. Now, to answer your question, in 2019, the reason why the markets are rising, despite investor nervousness and despite all this trade tension, is because, once again, global central banks, including the Fed, have been loosening monetary policy. An interesting point here is currently 60% of global central banks are in easy monetary policy mode. So that really has been juicing up returns.
Well, and there's been kind of a FOMO going on here, like fear of missing out. That people they see this going on and they're hopping on, and that's made the gains, exacerbated the gains that we've seen.
Absolutely. Not only is it a FOMO, a fear of missing out rally, it's also a unloved rally. Mm-hmm. And a result why there has been a dichotomy between the debt and the equity markets. On the one hand, we're seeing equity markets rise, and on the other hand, we're seeing yields fall. So on the one hand, investors are nervous. They're also buying utilities, defensives. One of the most popular trades in 2019 from an equity factor perspective has been low volatility and low volatility, basically. Mm-hmm. So that kind of speaks to the mood of the market and the dichotomy of the markets.
Okay, so you mentioned yields. So bonds have not really gotten a lot of attention this year, but that has been a good market.
Absolutely. Good market in the sense that, yes, bonds have been rallying, but we saw a near collapse of Treasury yields in the United States. From the 10-year anywhere from approximately 3% to, 1.5%. Yeah. We saw European bonds, government bonds in negative territory. And in 2019, anywhere between 10 trillion to 15 trillion of bonds have been in negative territory. I guess from a rally standpoint, it's good, but from a, hate to use the word bubble, but from an economic bubble perspective, it does raise some concerns as to how long or how deep will bonds get into negative territory, because at some point this has to normalize. Right. And it'll snap back, and there would be some mean reversion. And if bond markets move back aggressively with rates rising, this could bring some volatility and some correction into the equity markets.
Okay, well, maybe that will happen in 2020. We know we have an election. That's going to be hugely interesting. How much impact do you think the election will have on the markets next year?
Given the sort of polarized nature of politics, I think depending on who wins, it will have significant impact on the markets. However, ultimately, at the end of the day, it's policy driven, and if we see trade tensions de-escalating and we see a resolution in trade tensions, this should be good for the equity markets from a growth perspective. In which case, the Fed can start normalizing interest rates again. And remember, in 2017, we had tax cuts and deregulation. So that's a very strong tailwind for the markets as it creates capital spending, which creates capital formation. And as a result, we see economic growth. And as a result, we'll see earnings climb, growth GDP kick back into strong positive territory, and as such, equity markets starting to rally once again.
Well, Larry Kudlow was talking about a tax cut for the middle class. You know, I mean, it's an election year, so we could see a lot of kind of favorable policies to help attract votes. It's going to be very interesting.
It definitely will.
Definitely will. Thank you so much, Massud, for coming in.
Shane.
And thank you as well for joining us. We'll be right back.